So for the same amount of coverage of $500,000, John would have to pay $9,576 a year. Can you see that there's a stark difference? Hello everybody, my name is David from Haven, and today we'll be talking about whether or not you should consider term insurance or whole life insurance and which plan is suitable for you. But before we go into the topic at hand, firstly we want to understand what is the role of insurance in your financial plan. And once you understand the role of insurance, we'll be able to have in a good position to understand whether or not we need term insurance or whole life insurance. Okay. So at Haven, when we speak with our clients about the role of insurance in their financial plan, we tell them that the role of insurance is really for the purposes of protection and protection only. And since it's for protection, it is a necessary expense and cost, and you should keep that cost as low as possible. Because if you were to overspend on insurance or you overpay, it restricts your ability to save for the future and live life today. But we also understand that, under coverage or under protection could possibly cause financial distress in the event of a life crisis or even a medical crisis. Right? Which is why at Haven we tell our clients that you should consider when you're doing insurance planning, buy as much insurance as you need, but pay as little as you can. Because the role of insurance in your financial plan is merely a support plan. And the support is a support plan to the main plan. But what is the main plan? Well, the main plan is what we call the accumulation journey, where you are right now in a certain current position where you have some current assets, and your goal in this accumulation journey is to build your current asset to an even greater future asset using your income, right? So that you are able to achieve financial independence, to provide for your retirement needs, child's education, and even provide giftings, and eventually spend down and enjoy your retirement. And the most important part of this plan to ensure that it becomes a success, right, is your most important financial asset, right, which is your ability to draw an income. Right, your ability to draw an income is your most important financial asset, because with income, you are able to live life today, meet our current financial obligations, as well as build for our future. So income is really important. With income, we have a chance to ensure that our financial plan becomes a success. But what can cause our financial plan to fail? Well, it is the risk of the loss of the most important financial asset, the risk of loss of income. But what can cause loss of income? Well, we know that retrenchment can cause loss of income, but it is only a temporary event. Right? But what we want to look at are events that could cause a loss of income for a very long time or even permanently. Because in such cases, a person will not have the ability to meet their current obligations as well as to save for the future. So the three key events are, firstly, event number one, the risk of a premature death of a sole breadwinner of the family, leaving the surviving dependents with a loss of income. Event number two, it is the risk of an illness, and an illness that is so severe that it forces the person to have to stop work to focus on recuperation. And that could mean a loss of income for a number of years. And thirdly, it is the risk of an occupational disability, or an event that happens that causes a person to be unable to perform the material duties of his own occupation. Right? And so these are the three key events that could happen during the accumulation phase that could cause loss of income. And it's very important that we protect against such risk during our wealth accumulation phase. Right? But you see, the need to protect against such risk is only a temporary need, because when you have achieved financial independence, right, you no longer rely on a working income. So there's no need to protect against loss of income. Right? And so for these income loss events, it is only a temporary need. And therefore, for most cases, we strongly advocate the use of low-cost term insurance to cover for such events, right? Because term insurance is the most affordable way for you to get the right amount of coverage that you need. But, well, we have clients who come to us and say, well, what happens if I get sick at retirement? Or what happens if I get a disability at retirement? Right? And so these are valid concerns. So for such events, we do need some form of lifetime protection, right? And for medical expenses, hospitalization expenses, we need a hospital plan to cover for these medical bills, cost of treatment, daily ward and treatment charges. And having a good and comprehensive hospitalization plan would be able to cover against such risk, the risk of a medical crisis that happens at retirement. And lastly, the risk of a severe disability that causes a person to be unable to function on his own, requiring caregiving needs. And we need a long-term care plan in place to cover the cost of caregiving needs, even at retirement. So these are lifetime needs. But for these income loss events, it is only a temporary need. And the reason why we use term insurance is firstly, every premium that you pay for term insurance, it goes to provide for protection only. You're not spending extra money to build up savings into the policy. Secondly, it is very affordable. And thirdly, we are able to structure the coverage of the protection to your protection needs, so that we are able to keep the cost affordable, to make it cost effective. And what that means is that if you need a term plan to cover you up to age 55, we can do so. If you need it to extend it to age 65, we can do so. And having the option to do that would give you, will be able to make the cost of coverage manageable. But why is whole life insurance, well, more expensive? And why do we recommend term insurance instead of whole life insurance? And the reason is because for every dollar of premium that goes into your whole life plan, about 90% of the premium goes into the cash value build-up, which is a savings component within the whole life plan. Right? The remaining 10% of the premium will go to pay for the cost of insurance, to give you the insurance protection that you need. Right? So, which is why whole life plans cost about 10 times more expensive than term plan does for the same amount of coverage. However, this is for illustrative purposes only. The actual split between the protection and the cash value will really depend from insurer to insurer and the type of products. Now let's take a look at a case study of John. So John, he's age 30 this year, and his family profile is that he's actually the sole breadwinner of the family, and he has 2 young children. So John is concerned about the loss of income for his family in the event of his premature death, which is why he wants to buy $500,000 of life insurance to cover for his dependents' income in the event of his premature death. Right. So 2 plans were proposed. The first plan is a term plan, right? And the term plan to give him coverage all the way to age 64 years old, up to his expected retirement age. Right, and this is the time where it is a coverage to the point where he only needs to be covered up to his financial independence, because beyond financial independence, he does not need to rely on insurance protection because he is already financially sufficient. He has enough financial resources to provide for his family. Right. So for a $500,000 coverage, the annual premium would be $759 a year, which is about $63 a month. The advisor also recommended a second plan, right? And this is a whole life plan. And a whole life plan will essentially give John a permanent life coverage for a lifetime. And the premium term would also be to age 64. So for the same amount of coverage of $500,000, John would have to pay $9,576 a year. Can you see that there's a stark difference in the premiums? It's a difference of over $8,000 a year. So if John were to go for the whole life plan, it is very likely that he will not be able to afford the full coverage amount, right? And therefore, he has to get a reduced benefit. So at Haven, the reason why we actually advocate for term plans for most cases is because if you were to buy a whole life plan, the client will likely be unable to afford the cost of premiums. And therefore, he might be spending, overpaying, but at the same time, still not getting the amount of coverage that he actually needs. So today, I hope that the presentation has been helpful for you to highlight the differences between a term plan and a whole life plan, and why for most cases it makes more sense for you to get a term plan for your own protection needs. Thank you.